I am your current. Hi, we're right at the top of the hour, so we're going to get started. I'm Marcia Collins Morose, your Vice President of Programming, with our President, our USA President Shirley Johnson. One of our committee members is here with us, Monica Mauricio, as well as our guest today, Nina Mills. Nina Mills is with FERPTA Solutions. She is the queen of all things FERPTA, and that is a title that she so deserves. Her bio is very extensive, and I'd love to read it to you, but I'm not going to because we're short on time, and she's got so much information she needs to share with you. Let me just tell you how amazing this woman is, and let me give a shout out to our good friend Carla, because Carla actually connected us when we were in Sarasota a couple months ago, Monica and I, and we were so impressed with her presentation. In fact, I've already had her present for another group. So you'll be glad to know that Nina will be there for you. She will be there to help evaluate, consult, and engage as needed. So keep her in your, we used to call them Rolodex, your digital files. I just dated myself. Nina, take it away, please.
Thank you so much, Marcia. So as she said, my name is Nina. We have 30 minutes today, so I'm going to try to get through as many crucial things as I can with FERPTA. Whoops. And again, of course, my technology hates me more than ever. Let me stop share and go back and share again because it does not like me. Okay, there we go. I think that'll do it. All right, perfect. That's what I was aiming for. So today we are going to be talking about FERPTA. Going to give you guys a really brief overlook on how FERPTA works. A lot of information for the next 30 minutes. So luckily it's being recorded, so you guys don't have to take notes. So let's just start out with what exactly is FERPTA. FERPTA is the Internal Revenue Services regulation that allows the United States to tax foreign sellers on dispositions of U.S. real property interest. It's important that you understand that it's focused on sellers, meaning FERPTA only comes into play when foreign sellers are disposing of their property. It does not impact when foreign investors are purchasing, although ideally foreign buyers will one day become foreign sellers and FERPTA will follow them there. Um, the purpose of FERPTA withholding is simply to ensure that the Internal Revenue Service has enough money here in the United States to cover any capital gains tax liability that may arise from the sale of this property. This is really super important because every time a foreign national sells a U.S. property, it's considered an investment property sale, which means it's always subject to capital gains. So even when they're selling properties that have not actually been rented, it's still considered investment because they can't have a primary property in a country of which they are not a resident. And the whole reason FERPTA was instituted is because the IRS realized that it made more sense to hold money here and make the seller come back and do something and settle with the IRS to get a refund later than it did to try to go next year to say, Madagascar or somewhere and get that person to file a US tax return and pay the taxes that were due. Honestly, that was probably the most sensible thing the IRS has done in a long time, possibly ever. But because of the way this works, a lot of people under confusion that this is actually the tax when it's being held at closing, and it isn't. It's important for our foreign sellers to understand that it's simply a withholding to cover the tax that they may owe. And FERPTA withholding is based on gross sale price to cover capital gains tax, which is based on profit. So two totally different things. And because of this, probably 98% of our sellers are going to get a significant amount of this withholding released to them once they complete the process. Now, when does FERPTA apply? Anytime a foreign national sells or a foreign entity sells a U.S. real property interest, it's pretty basic. If it happens and a foreign national is the one that's doing it, FERPTA is going to apply. Sale price, use of the property, gain, loss on the sale, none of those things determine if FERPTA is going to apply to a sale. The driving force behind applying FERPTA is simply the status of the seller. If the status of the seller is non-US resident or non-US entity, FERPTA is going to apply to that transaction. Regardless of whatever else you've heard about anything anywhere else, full stop, the beginning driving force behind FERPTA is the seller's status. Now, who exactly is subject to FERPTA? So who is considered a foreign seller? Foreign sellers are individuals. That's pretty obvious, right? They're foreign owned corporations. That means we're talking about corporations that were formed outside of the United States. So, yes, if your company was formed in Canada and you buy a property here, when you sell it under your Canadian company, FERPA is going to apply to that transaction. Or your Bahamian company, or wherever it may be, a corporation formed outside of the US that does not elect it to be treated as a US company is going to be subject to FERPTA when they sell. LLCs can be considered foreign sellers, and trusts can be considered foreign sellers as well. So this is particularly important, I feel, in the commercial community and globally, because a lot of our foreign investors are coming in and they're forming LLCs, they're forming trusts. Both things I highly recommend if your clients, when they're investing, when they're buying the property, if they are just thinking about doing an entity or thinking about a trust, they definitely want to sit down with an accountant that specializes in this, like Purpose Solutions, or even a real estate attorney if you're looking to form a trust. Our company actually has some that we collaborate with, so your clients can come to us and we connect them with that as well, so that they can be sure that what they are trying to purchase is exactly what they really want and that it fits their needs. Um, LLCs are not the same for everybody. There are sole proprietorships, there are partnerships, there are C Corps. Those are the three things that foreign nationals can form. But how those work depend on exactly how they're formed and depend on where your client is from. So different countries have different tax treaties with the US, and all of those things are impacted by LLC formations. So when it does come to forming LLCs, and I will take a couple minutes on this because I think this is something that we're seeing more and more of, foreign nationals have that option of forming that single member LLC, the partnership, or the C corp. Now, definitely, like I said before, recommend that they meet with an accountant to make sure that forming an entity makes sense. Number one, and that the entity they're forming is the correct one for their particular goals, country of origin, etc. When they form a single member LLCs are treated just like the person who formed it. So my best illustration is that this is like forming, like putting a sweater on. So, we're talking earlier today that it's so cold, right? So we're putting jackets on to combat against the cold. It's kind of what a single member LLC does too. It puts a cover on the property to protect it from liability, but it doesn't really do anything super great for the person. And what that really means is that when they sell, when they report income and expenses, all of those things actually run through the individual. So when they get ready to sell, the IRS is going to look at the status of the individual. So what they're going to do is they're going to say, hey, take off your coat. Let's see your status t-shirt. And if your status t-shirt says, hi, I'm a non-US resident or non-US entity, then FERPA is going to apply to that single member LLC. When our foreign nationals form partnerships and C Corps, things are a little bit different. In those cases, the IRS doesn't really care what your status t-shirt says. All it cares about is where you're hanging it at. So all it really cares about is what closet your t-shirt's hanging in. And if your partnership and your C Corp were built in the United States, then they're US closets. And that's all that we care about. So when it comes time for selling, all we're concerned about is that that's a US partnership closet or a C Corp closet. And if that is the case, we do not care where your t-shirts and coats come from. All we care about is where your closet was built, and FERPTA does not apply to that sale in that case. Now, keep in mind, one of the reasons that I'm saying it's very important for your clients to meet with an accountant before they form an entity is because forming a partnership or a C Corp will avoid FERPTA, but it does not make them exempt from capital gains. It does not make them exempt from filing tax returns. It doesn't make them exempt from state tax returns if it applies in that particular state. There are still things that have to be paid, returns that have to be filed, and sometimes, depending on the entity they form, that entity may be beneficial in the United States, but not necessarily so in the country that they're from. So it's very important that they're choosing an entity that works not only for them here, but also in the country that they're from, because keep in mind, they are required to report their worldwide income somewhere other than the US. Now, when it comes to trusts are just, whoa, that they're like the bane of my existence. With trusts, we have to look at a couple of different things. Are they revocable? Are they irrevocable? What I typically look at, the general guideline for trusts to determine if FERPTA will apply when they're selling, is one, is it revocable or is it irrevocable? If it's revocable, where are the beneficiaries domiciled at? Are they from the US or are they not from the US? And the answer to that 99% of the time will tell us whether FERPTA will apply to a sale being sold by a trust. When it's a irrevocable trust, we have to look more closely about where was the trust formed, simply because irrevocable trusts tend to be their own entity. And a lot of times they can be formed outside of the US and be subject to another country's laws and not the US's. If that is the case, FERPTA will also apply when those trusts sell. But if the trust was formed in the US or if the beneficiaries are actual US people, when those properties are being sold in trusts, FERPTA will not apply. So a lot of different things going on there. A lot of things applied. Again, really important to meet with accountants and attorneys to be sure that your clients are doing the right thing before they actually close on the property when they buy it. Now, something that's really big right now is the subject of immigration. So we've got a couple of types of things that are happening with immigration and taxes and FERPTA. And the first thing is that resident aliens are hot topics right now because resident aliens are foreigners that are not US citizens or residents, but they are considered US residents for the purpose of taxation. And what that really means is Uncle Sam is going to get their piece of the pie. They're cool with that, right? They want to take their money from any resident aliens and they're okay with that. If you have a seller who is considered a resident alien, their sale of US property is not subject to FERPTA. But we have to confirm that the resident alien is their actual status, and we do that by performing one of two tests. And it's important to note that when it comes to FERPTA, every owner on the property is evaluated separately. The IRS does not recognize married couples as one unit. Everybody is evaluated separately because every one of the owners can have a different status. But the first test that we look at is the green card test. Green card test, super, super simple. They either have one or they don't. And if they have one, the card has to be current, it can't be expired, and they must be in possession of it. As long as they have their green card and they can provide it to title as proof that they are indeed a resident alien, title will have them sign something called a certificate of non-foreign status. Those items will go in their file and the sale will proceed just like any other sale. FERPTA will not apply. But if they don't have a green card, but they've been here a while, we probably want to look at the second test, which is simply the substantial presence test. Now, the substantial presence test is a little more complicated. This is definitely the mathingest math section of determining residency, and it is based exclusively on physical presence. So I'm actually kind of glad that we're having this class today on January 2nd, because this gives me a really great way to illustrate this. So the substantial presence test is unique in the sense that in order for it to apply and be applicable to the particular person, that person must have been in the US for at least 31 days during the current year. We're on January 2nd, guys. Clearly, they have not been here 31 days in 2026. So that means we cannot close in the month of January. We can close on February 1st because they can meet that criteria then if they've been here all of January. But because this is the IRS, we're not looking just at this year. We're going to look at the year of 2025, and we're going to be looking at 2024 as well. And because it's the IRS, we don't get to count all of the days. We only get to count a third of the days in 2025 and a sixth of the days in 2024. So we have ugly fractions, multiple years that all have to be counted, combined, added up into this formula. And if the total formula days ends up being 183 or more days, that client can be considered a US resident by substantial presence, meaning that they have physically been in the US long enough to be considered a tax resident and their sale is exempt from FERPTA. Now, important to note that the actual immigration status of a person and the tax status are two different things. When we're doing the substantial presence test, I'm not concerned with, whether you're here legally or illegally. That's not relevant. I'm simply concerned with how many days you've been in the United States. It's also important to note that not all people can use substantial presence tests because one of the things we do look at is what type of visa are they here on or did they come here on? Certain visas do not allow us to use SPT, and there are a gazillion visas, it seems like. I think there's 25, 30 plus different visas you can get, probably more than that. And some of them are eligible for SPT, some of them are not. So, a great example of one that is not is the G4. The G4 does allow foreign nationals to come in and work. So, maybe they're working at the United Nations in New York City, for example, but they're not actually considered US residents, so they don't pay taxes here. So, when they sell their properties, they are subject to FERPA. E2 visa holders are eligible to use substantial presence. They're pretty prevalent. Student visas are actually kind of a funny one. Those are your F1, F2s. They actually have to be in the US for 5 years before we can actually start counting days for substantial presence. So there's a lot of different things that happen to determine if someone is eligible for substantial presence. And because of that, we are seeing an uptick in title company and closing attorneys requiring a CPA certified letter stating that they actually meet the SPT conditions. That is something that we can provide for your clients. And if they do meet those and the letter is provided to the title company closing attorney, then they will also be eligible to sign that certificate of non-foreign status. Everything will go in their file and there'll be no reason to withhold FERPTA at closing. So, a couple different things that we can do. And like I said, I think the most important part of this, again, is that immigration and tax status are two different things. We're not worrying about immigration status, we're trying to determine tax status for your clients. So, I bring that up because I'm seeing that a lot right now in Florida. People who've lived here for years, they're suddenly selling because they're concerned. They legally they may or may not should be here. I don't care. I just need to determine whether they actually are considered US residents for taxes or not and whether FERPTA applies, and that's the entire purpose of substantial presence. Now, 1031 exchanges, just want to talk about this super fast. 1031 exchanges are amazing. They are a fantastic way to postpone having to pay your capital gains. I think most of you guys probably know the general gist of the 1031 exchange. You have to sell for one property, reinvest 100% of your proceeds in a second property of equal or greater value, and you have to do it within 180 days from the first sale to the second sale. Pretty simple, right? And if you do that, you're able to kick your capital gains liability down the road. Theoretically, you can keep doing that, keep doing that, keep doing that, and leave that mess for your kids to clean up as they should. I'm just kidding. We don't want to leave that mess for our kids, but could do it that way. Foreign nationals are also eligible to do the exact same thing. However, there's a catch because foreign nationals are still subject to FERPTA even when they do a 1031 exchange. So when your foreign national clients are looking to do a 1031 exchange, and we're talking strictly American, American property to American property, they can do it, but they need to be prepared to bring the equivalent of the FERPTA withholding to reinvest in that second property, just in case. So the reason is because it used to be that we could actually get the IRS to rule on a 1031 exchange within about 30 days or so. That's not the case anymore. And to be fair, we are thinking it's going to be about 6 months. We actually are not 100% sure yet. So, in case it is longer than 6 months, they need to have that backup plan in place. If we were able to get the paperwork done, then of course they don't have to worry about it, but they do want to be prepared before they do the 1031 exchange, just in the off chance that the IRS is not moving as fast as we're actually anticipating them to be moving in 2026. But it is definitely an option that's there. And my understanding is apparently on the international front, there is a 1031 exchange option for international exchanges as well, but this is strictly talking US. So we talked about 1031 exchange. We talked about what FERPTA is, SPT, all of these things. Let's talk really quick about exemptions to FERPTA. One is there's no automatic exemptions for FERPTA unless you are a US entity or a US resident. I heard something interesting that said really we should treat every sale as if it is subject to FERPTA until we prove that it isn't. And I kind of like that idea because honestly, that is kind of the truth, right? Because there's no automatic exemptions for FERPTA unless you are a US entity or a US resident. Instead, what there are affidavits that the buyers may choose to sign that will alter the way title is required to handle FERPTA. But there's some caveats to these affidavits as well. One is that only individual buyers are allowed to sign them. And two, that applies even if it's a single member LLC, which seems a little counterintuitive, right? Because we know that single member LLCs are taxed based on the owner of the LLC. But when it comes to affidavits, there can't be any element of business. So if the buyer is an LLC, they're not allowed to sign these affidavits, even if they're purchasing the property to be the primary resident of the owner of the LLC. So just keep in mind that these affidavits are strictly for individuals to sign. So the first affidavit is for properties less than 300,000. Now, I don't know where you guys all are at, but where I'm at, there's like 6 properties that meet this criteria, I think. Um, I'm not kidding. There's a few more than that, but not very many. If it's less than 300,000 and the buyer intends to reside in the property for more than 50% of the occupied time for the next 2 years, and the buyer agrees to sign the affidavit. Agrees to sign is key here. They are not required to sign it. FERPTA will not apply to the transaction. Title does not have to withhold anything. Please keep in mind that if the buyer chooses to sign this and no FERPTA withholding is done, it does not mean that your client is not still required to file a tax return and settle with the IRS, because they absolutely are. In fact, it's really actually more imperative that they do so if the buyer signs this, because the buyer is the one that already has the responsibility and the liability if FERPTA is not done correctly. So if a buyer does your seller a solid and signs this affidavit, they definitely want to make sure they go back and settle with the IRS to kind of return the favor, so to speak, to the buyer signing this affidavit. A little bit of risk in this one for the buyer. Because of that, I'm not a fan, but it is out there and it is available for your buyers to sign and your sellers to use as a bargaining chip with buyers. Now, the second affidavit I love. I think this is probably as close to a win-win as we're ever going to get. This is strictly for properties that are more than 300,000, but less than a million. If it's in that price point and the buyer intends to reside in the property for more than 50% of the occupied time over the next 2 years, and they sign this affidavit, title is still required to withhold, but they only have to hold 10% of the gross sale price. This is really good news for everybody involved. The buyer is protected, the seller gets relief. I think it's a great affidavit. And you're probably thinking it's a 5% difference, what's the big deal? But even if a house is selling for $500,000, if this affidavit is not signed, we're withholding 75,000. If it is signed, we're holding 50,000. 25,000 is a pretty significant sum of money, in my opinion, especially if you're looking to reinvest or you're looking to repatriate your money somewhere else. That can be a make or break type situation. So I think this affidavit is fantastic. It's out there, it's available, and honestly, I don't see it used as much as I thought I would. And if your property is selling for over a million, unfortunately, you're just stuck. It's going to be 15% across the board, regardless of what the buyer is going to do. Now, the FERPTA process, there's 2 ways this can be handled. The first one's super duper easy. Money goes to the IRS at closing. We send some forms. The money stays with the IRS until we file their tax return. For property sales today, and they opt with this, the money's being sent to the IRS. It's going to sit with the IRS until next year, because it's now a 2026 transaction. And we cannot file the 2026 tax return until February of 2027. So if a client sells today and opts for this one, they're looking at getting their refund back probably about May of 2027. So they're looking at probably about, I'll say 15 to 18 months, which seems like a long time, right? But it's basically just a timing situation, because the process for this particular option stays the same as we move through the year. It's just the time between when closing happens and the time we can file the tax return shortens. So it can make it appear late in the year that this is a better option, and sometimes it is. But this one's very straightforward. Like I said, the full FERPTA goes to the IRS and sits there until we can file their tax returns. Now, the second option is the FERPTA withholding certificate. So we are going to see a comeback for these this year. This is my prediction for 2026. So FERPTA withholding certificates are something that most accountants have not been doing since sometime in 2023. And that's simply because it didn't make any sense. Because with a withholding certificate, what we're actually doing is we're preparing an application to ask the IRS to go ahead and review the seller's situation. It is just a snapshot. So it's not their final tax deal, but it is a snapshot based on that individual property and what we can show about that property. The thing about this is that this is actually a process used to um, enable our sellers to get part, if not all of their money back within a shorter amount of time. So if we file a withholding certificate today, we are predicting based on what we're seeing at the IRS right now, and the IRS and predicting are that's a tough call. We really do need to be psychic to make a real determination, but we're anticipating that we will see roughly about June a withholding certificate will be issued. The way this works is that when we prove our application, if we prove to the IRS that they are selling for a loss, the IRS will come back and they will issue a withholding certificate saying that no funds have to be sent to the IRS. That doesn't mean they don't still have to file a tax return because they do. But based on the IRS's preliminary review, no tax will be due in connection to the sale of that particular property. So that's a really great option for our sellers going into this new year. If they do decide that the seller is selling for a gain, the IRS will come back and ask for 20% of the gain to be sent to the IRS. We'll then file the tax return, do all the other things, add to it that will actually determine their final tax liability. And probably about 99% of sellers will get an additional refund when their tax return is actually filed. So the way that will work is say we have a personal use property, say they're selling for 400,000, we're holding 60,000. They do a withholding certificate. We think they have $100,000 gain. The IRS comes through, they do their certificate and they say, hey, you know what? You're right. They do have $100,000 gain. They're going to ask for $20,000 from the 60 that we're holding. We're going to send 20 to the IRS. We're going to release 40,000 to the seller in 6 months. And then when we file their tax return next February, we're going to actually apply the capital gains bands for 2026, which I actually have not looked up. But in 2025, it was roughly $48,000 per person. So it should be slightly higher for 2026. And then we're going to apply the bands, apply the appropriate rate, and they're going to get an additional refund of some portion of that $20,000. The real advantage to the withholding certificate is getting at least part of that money back within a timely manner without making them wait the full, 15 to 18 months. So this is definitely going to make a comeback in 2026. And I'm going to pause through this because I already went through with it. Now, US tax numbers, going to finish this up really quick. I got 2 minutes. These are super critical. Uh, Foreign sellers must have a valid US tax number to get any portion of their FERPA withholding back. That's fine. We can absolutely apply to help them get that. Please note that having a social security number does not negate the need for FERPA. You can be a non-US resident subject to FERPA with a social security number. But if you do not have a social security number, we are absolutely going to have to get you a US tax number or your withholding will not get released. I'm not going to go through that. And the answer is, can you just ignore FERPTA? I'm going to go with no, because the buyer is the one that's going to suffer all of the penalties and things from the IRS. Penalties are pretty high. Failure to pay, failure to file, plus interest can equal roughly about 5.5% times the withholding amount each month until everything is satisfied. So we definitely don't want to ignore FERPTA. Instead, we want to make sure that we're working with accountants, real estate attorneys, title companies, and realtors that understand FERPTA and international investment here in the United States. This is our contact information. Miss Marcia has my personal email if you guys would prefer to email me, but info@FERPTA Solutions will definitely get you to someone on the team that can also assist you. And like I said, she can always provide my personal email if you prefer to speak directly to me, but we are here to help you guys. And that is it.
That was incredible, and it always is. There is a question in the chat. I'm going to borrow an extra minute or two of your time. What happens if the seller was a resident when they purchase, but are no longer a resident when they sell? They're subject to
So
FERPA, right?
Correct. So basically, it is based on their status at the time they sell. So if they were a U.S. resident when they bought or considered a U.S. resident, maybe a green card holder, but they let their green card go back, when they sell it, they would be subject to FERPTA. But the other way works the same too. So if they're a non-resident when they buy
Oh.
and they get a green card during the course of ownership, when they sell, they would not be subject to FERPTA because their status has changed.
So I will tell you that those withholding certificates were very instrumental in getting a lot of the short sales pushed through because there was no money. There was no money for those for any type of withholding. So luckily for me, those were mostly my Florida clients. Sad for them, but the attorneys were more, they were well versed with this, which many times attorneys in other markets are not. I mean, Florida is very much an international marketplace. So, and by the way, Nina's in Southwest Florida, and I suggest when we're on the road again that we pay Nina a visit, right? I'd love that. We'd love to take you to
Yeah,
lunch and pick your brain a little bit more. Any last question? If anybody wants to unmute, you can quickly ask a question. Otherwise, we'll release Nina to enjoy the rest of her first day back. Are you back at work or one more day?
technically not till Monday. I just came in for you guys today.
Okay, Edward just raised his hand. Edward, you're unmuted. Go ahead, ask your
Uh,
question.
the question was, I came late. Is this being recorded? Can I get a
Yes.
copy? Perfect.
Yes, yes, yes,
Thank
yes. Yeah. Yeah, that's one thing that I'm so glad to report to you all that we're doing that. They're going to be available. The recording will be available. And Nina, if you need her information, if you didn't catch it on the screen, visit the recording or drop me a message and I'll go ahead and Nina, you could drop it in the chat if you want real quick.
I will do that real quick. I was thinking that.
Yeah, you guys can grab it there. We won't hang up just yet. But she's invaluable. You can run questions by her. She'll consult with your clients, and they do more. I mean, FERPTA is huge to begin with, but they help with all the other process and procedures that are so important to make sure you're on the right track. Even so much so as to suggest the correct way to hold title, if I remember from our last session. Yeah, so she's got a lot more a lot of information. Take advantage of having her in, as I said before, in your digital file, or as the older folks know it as a Rolodex.
Rolodex. Yes, ma'am.
Right, Shirley?
Yes, ma'am.
So,
We
Old and happy to
absolutely
be so.
help.
so again, thank you so much. Happy New Year, everybody. Thank you for signing on today. And did everyone get a chance to copy that quickly? Nina's contact information. If not, you know how to reach out to me. So thanks again, Nina. Good to see you. Enjoy
Thank
the
you,
rest of your
everyone.
day. Thank you, everybody.
Thank you. Happy New Year,
Thanks.
everybody.
Happy New Year. Bye-bye.
Bye.
Bye bye.